Welcome to the big interview here on Money Life. And, well, today we are really fortunate. We're having two big interviews, but they don't get much bigger than what we've got for you today. And my first guest, I have not talked with him for years, but I'm really excited to talk with him now. His name is Marc Chaikin, and he is the founder and chief executive officer at Chaikin Analytics. If you haven't heard of Chaikin Analytics, you just haven't really been spending any time learning about market research, because he's got basically, I don't want to call him old, but he's got a half century of experience in quantitative models and putting together all this stuff. He was a stock analyst for a long time. He started Bomar Securities and a number of other things, and he's been around the industry, but the great part is he is here now to talk with us. But before we do that, if you want to learn more about Marc and his firm, go to ChaikinAnalytics.com. It's at Marc Chaikin to follow him on Twitter, at Chaikin Analytic on Twitter. Marc Chaikin, welcome to Money Life.
Chuck, great to be with you.
So, like I said, I don't want to call you old, but you do have a considerable amount of market experience. And we are at this spot where, well, we kept expecting changes, and we've gotten bits of them. Like we went through last year where there was no volatility. Volatility came back into the market. People said, okay, here we go. We're going to have some setback or we're going to do whatever. Nope. All we've really had is volatility. We got into a rising interest rate environment and people said, oh, it's going to crater the bond market. But the Fed telegraphed it and we kind of went through it until recently. And now the bond market's suffering, but it's not cratering. So how much of this is just, to you, business as usual? How much of this is, no, the market's actually changing and this isn't business as usual?
Well, I think this is actually pretty predictable. We went from, as you pointed out, a bull market on autopilot in 2017 with no volatility to a correction of more than 10% in the S&P 500. When you get a correction of more than 10%, typically bottoms out in the shape of the letter W. We've sort of seen that pattern fall into place, and now we're just waiting for second quarter earnings, which I think are going to be spectacular. And that's not just me. The FactSet is telling us that they expect a 20% increase in second quarter earnings. So we're in a period of rising interest rates and rising earnings. This is very bullish, and it's exactly what you want. And so the people who are agonizing over a 3% 10-year Treasury yield, I think, have gotten it all wrong. It's actually bullish when interest rates are going up because the economy is strong. So this is all very predictable, and I think that the market is just waiting to break out, just as the small caps did last week. So we've got a market that's being driven by earnings, and I think it's going to continue.
That being the case, it's going to continue, but is it going to continue with the same kind of returns we've seen for most of this bull market, or is it going to be somewhat muted returns? And if the returns are muted, do you get the same kind of better returns that we've been getting by turning more of your attention internationally?
Well, international has been a trap for people. In the first quarter, money flowed out of U.S. mutual funds and ETFs and into emerging market and international ETFs, and guess what underperformed in the second quarter so far? International and emerging markets. So no, I think we've got the steady economy. We've got the sovereign debt that's stable as opposed to what's going on in Italy and Greece and a little bit of Spain. So I think the opportunities are in the U.S. markets. And what's interesting is if you look back on Friday's price action, the industry groups that led the S&P higher were the industry groups and sectors that typically do well in a rising interest rate environment. So you had technology, energy, financials, industrials, and materials all performing better than the S&P 500. So I think we're in a very predictable environment. The key, because the returns will be more muted than they were in 2017 when the S&P was up around 20%, is to pick your spots and use volatility to your advantage by buying dips. Paying up for stocks makes no sense here because returns will be muted. We've had a long-standing target of 2850 to 3000 on the S&P 500 before the end of 2018. That target is still in place. We hit the lower end of it earlier in the year in January. I think we're going to revisit those numbers and maybe get as high as 3,000, again, based on a very strong economy in the U.S.
You talked about second quarter earnings and how good you expect them to be. We, of course, had great first quarter earnings results. Much of that was aided by tax reform. It is tax reform that's going to continue. It's not, hey, you got a one-time shot in the arm and it never happens again. But there are plenty of people who are thinking we're going to get a quarter or two where we have the tax impact and then everything's going to normalize. And when it normalizes, we'll have a come down. Are you thinking that that's what happens, or do you think, no, this is perpetual tax reform, so whatever we've seen, it's now going to be built into the system and everything forward's going to be different, but there's no reason to assume we have to have a drop-off?
Well, Chuck, nothing is forever, but I do think that it's going to lead to capital expenditures. We look at individual equities based on a multi-factor quantitative model that I built in 2010, which moved me beyond technical analysis, which is what you and I talked about 15 years ago, Chaikin money flow and other indicators that measure supply and demand. So when we look at the Chaikin power gauge rating, which is what we call our multi-factor model, we can zero in on areas of opportunity, for instance, in the energy sector, where the refining stocks are really benefiting from not just a rising price of energy, but the efficiencies of merger and acquisition. We can look at technology and see stocks like Micron and Akamai and Facebook, which have a bullish rating in our model. And we can then go to the financial sector where you've got sort of bifurcated opportunities. Insurance companies with bearish ratings, but the online brokers and some of the specialized investment banks with bullish ratings in our model. So I think you really have to pick and choose your spots. In terms of the overall market, there's no sign of a recession in place. The four indicators we look at that have typically signaled well ahead of a recession just aren't. They're almost comatose. Leading indicators being one of them, very strong, usually turns down before a recession. So this bull market could go on a lot longer than people believe. Now, I know nothing is forever and bear markets are a fact of life every 4 to 5 years, but think about how this bull market began in one of the worst financial nightmares in our lifetime, certainly. I'm not old enough to have lived through the Depression, so you can scratch that off your list. But we started this bull market in very unusual circumstances, and granted, it took quantitative easing by the Federal Reserve to get us out of that big hole that we were in. But we haven't had a big booming economy. We haven't had that sort of overheated economy that leads to an inverted yield curve, interest rates skyrocketing. It's been slow and steady, and I think it could continue a long time. I'm not going to predict when. I think the earliest we're likely to see a recession is late 2019, but there's no guarantee that that happens, because if the economy doesn't overheat and we continue to get this sort of sector rotation that's been going on where energy and now biotech have taken over for financials and industrials in terms of market leadership, small caps now starting to outperform large caps, which is healthy in general. This could go on a long time. And so the people who are looking for a bear market around every corner and a turn down in the economy are going to be missing out on big opportunities, just as they did in 2017 when everybody was waiting for a pullback that never came.
You have been watching this for a long time, as we've said. How much do you take a look at developments like Bitcoin and cryptocurrency versus developments that you've seen, I don't know, ranging from when we stopped trading in eighths and, started making it, you could trade by the penny and all this other sort of stuff, and see technology changing the markets? How much of it is just, technology always changes the markets. Don't go crazy about anything that is new, because new isn't necessarily going to be new for long.
Well, Bitcoin's an interesting phenomena, and blockchain, more importantly, is a very valid technology platform. A recent example of that is Akamai, which provides a platform for people to deliver content over the internet fast and efficiently. They announced a joint venture with Mitsubishi, the big Japanese financial complex, to provide blockchain-based online payment capability. So I think you have to be aware of how disruptive this new technology can be, but I think this is all very bullish. What it does do, though, is it sort of changes traditional ways to look at valuation. So, for instance, book value isn't as important a metric, even though it's part of our 20-factor model, as it used to be, because we've gone from a manufacturing economy to a service economy. So something that's disruptive, that can lead to more efficient online payments, actually is more important to a company's future potential than book value, because assets are no longer measured in terms of bricks and mortar. It's your brand, it's your customer loyalty, and it's your engagement with your client, or you're in a B2B company like Akamai, your partners. So I think that you do have to be aware of technology, because it changes the way you value companies and what the metrics are that you need to look at to determine whether a company is going to continue to be strong. So Facebook and Amazon are just two examples of that. Amazon, by traditional metrics, very expensive. If you look at it in terms of the disruptive technology that they're bringing to the retail space and to cloud computing, you've got a different way to look at the valuation.
Marc, this has been fascinating. I have many more questions. I don't have more time. So hopefully we'll get a chance to chat with you again in the not too distant future.
Chuck, that would be great. I enjoyed the time with you.
Thank you very much, Marc. Marc Chaikin, everybody. He is the founder and chief executive officer at Chaikin Analytics. ChaikinAnalytics.com is the website. At Chaikin Analytic is the Twitter handle. And Marc's on Twitter. He's at Marc Chaikin. Now, I promised two great big interviews. Well, the next big interview is Christine Benz from Morningstar. She'll be here when we come back right after this message.